Most people think silver is quiet, slow, something that sits in vaults, gets mentioned briefly on financial news, then disappears again. But that belief is exactly why what is happening now is so dangerous, because silver does not usually shout before it moves. It whispers. And right now, that whisper is turning into something much louder. Here's the mystery. At the very moment when technology, energy systems, and modern infrastructure depend on silver more than ever before, the global system that supplies it is tightening instead of expanding. Prices move in strange ways. Inventories quietly shrink. Delivery times stretch. And yet, the public narrative insists everything is under control. That contradiction is the first signal that something deeper is breaking. To understand why silver is beginning to strain the financial and industrial system, it helps to start far from today, in a time when silver was not a commodity at all, but the foundation of money itself. For thousands of years, silver functioned as trust made physical. Empires minted it into coins, merchants weighed it by hand, and entire trade networks relied on its scarcity and durability. Unlike paper promises, silver could not be created by decree. Its limits were defined by nature. That reality shaped economic behavior for centuries. When silver flowed freely, trade expanded. When it tightened, systems cracked. History shows this pattern again and again. Ancient economies did not collapse only because of war or politics. Many failed when the metal that underpinned trust became scarce, debased, or mismanaged. Silver shortages did not announce themselves with panic. They appeared first as small disruptions, missed payments, delayed wages, rising prices that seemed temporary. Only later did the consequences become obvious. As modern finance evolved, silver's role appeared to fade. Paper currencies replaced metal coins. Central banks gained power. Markets became digital. For a while, silver seemed pushed to the sidelines, treated as a leftover from an older system. But that disappearance was an illusion. Silver did not lose importance. It simply changed jobs. Instead of backing money, silver became embedded inside the physical world. It moved into electronics, medical equipment, water purification, aerospace systems, and energy infrastructure. Its unmatched conductivity and reliability made it irreplaceable in ways few people noticed. Each smartphone, solar panel, data center, and electric grid quietly absorbed small amounts of silver. One device did not matter. Billions of devices did. At the same time, the financial system treated silver as abundant. Prices stayed relatively low compared to other assets. Mining investments slowed. Exploration budgets shrank. Recycling never scaled fast enough to compensate. The assumption was simple and comfortable. Supply would always adjust. It always had before. But assumptions age poorly when systems change faster than habits. As renewable energy expanded, silver demand accelerated. Solar technology alone began consuming massive quantities year after year. Unlike jewelry or coins, this silver did not come back to market easily. It was locked into panels designed to last decades. Add to this the growth of electric vehicles, advanced electronics, and medical technology, and the picture shifts from balance to pressure. Still, the warning signs remained subtle. Inventories declined slowly. Industrial buyers competed quietly. Large institutions secured long-term contracts. The public saw none of this. Price movements were explained away as speculation or short-term volatility. The deeper structural shift went largely unexamined. Then another force entered the equation. Financial complexity layered itself on top of physical reality. Paper claims on silver multiplied far beyond the available metal. Futures contracts, derivatives, and synthetic exposure expanded liquidity without expanding supply. On screens, silver appeared plentiful. In vaults, it was becoming harder to find. This is where systems begin to fracture. When confidence depends on smooth delivery, even small delays matter. When multiple claims rest on the same underlying asset, trust becomes fragile. No announcement is required. Stress builds invisibly. What makes this moment different is timing. The world is not reducing its reliance on silver. It is increasing it at the exact point when flexibility is disappearing. Mines cannot be restarted overnight. New discoveries take years. Recycling depends on prices that make recovery worthwhile. Every solution arrives slower than demand. The result is not immediate collapse, but tension. A system stretched thin can appear stable right up until it is not. Prices may surge without clear explanation. Industrial buyers may outbid investors. Financial instruments may disconnect from physical reality. Each of these looks like noise on its own. Together, they form a pattern that history recognizes. Silver is not simply rising or falling. It is pushing against the limits of a structure built on outdated assumptions. And when assumptions fail, systems change abruptly. Most people are not watching this happen. They are looking elsewhere, distracted by louder stories. That is why the early stages feel quiet. But quiet does not mean safe. It often means unprepared. Because once silver stops whispering, it does not ask for attention. It takes it. The moment of tension becomes visible when multiple factors converge, and that is what is happening today. Mines are producing at near maximum capacity, but growth is slow. Large-scale recycling operations cannot keep pace with rising demand, and inventories held by institutions are dropping faster than anyone predicted. Analysts who rely solely on spreadsheets often fail to capture the physical realities behind the numbers. The result is a gap between perception and truth. This gap is where opportunity and risk intersect. Investors who understand the system see patterns that others cannot. They notice that the paper market no longer aligns with the physical market. They see premiums rising on physical delivery, longer wait times, and large buyers willing to pay much higher prices than the quoted futures. These are signals the mainstream rarely reports, and the media often misinterprets them as short-term speculation. In reality, they reveal structural stress. Industrial demand continues to accelerate. Solar panel production requires more silver each year, and the global energy transition is just beginning. Electric vehicles incorporate silver in batteries, sensors, and electrical systems. Medical technology, especially in diagnostics and treatment equipment, adds additional strain. Unlike precious metals held in vaults, this silver is not readily recycled. Once it is integrated into these systems, it is effectively removed from short-term supply. Meanwhile, financial institutions are adapting. Large banks and funds have secured long-term agreements to ensure access to silver, often at higher prices. This means they are competing directly with industrial users. The dynamics of supply allocation are shifting quietly, and the traditional signals of market stress, rapid price spikes, have only started to appear, yet the broader public remains unaware. History offers a roadmap for what comes next. When critical resources are constrained while demand rises, markets behave unpredictably. Early stages often appear stable, creating a false sense of security. Prices fluctuate modestly, contracts are met, and news coverage frames movements as normal market behavior. But as the underlying scarcity becomes undeniable, volatility increases sharply. We have seen similar patterns before in other commodities, though few have the same dual role as silver. Oil crises, rare earth shortages, and financial panics all follow this pattern. Slow buildup of stress, quiet accumulation of tension, and sudden market recognition that the system cannot adjust quickly enough. The difference with silver is that it is deeply intertwined with the technological backbone of the modern economy. Disruptions in silver supply have broader implications beyond investor portfolios. They affect renewable energy deployment, electronics production, and even medical equipment availability. Adding another layer, geopolitical factors amplify uncertainty. China, one of the largest holders and consumers of silver, has adjusted its inventory policies. Large-scale stockpiles that once buffered the market are declining rapidly, creating ripple effects across Asia, Europe, and North America. Governments and corporations scramble to secure physical silver, often bidding against each other in ways that push premiums higher. The result is a feedback loop. Scarcity drives price spikes, which encourage more physical hoarding, which further tightens the market. Technological demand is also accelerating unpredictably. Emerging innovations, high-efficiency solar cells, advanced energy storage, and next-generation electronics require precise amounts of silver. Even small miscalculations in supply planning can create localized bottlenecks that quickly become global news. These disruptions are not always reflected in headline silver prices, which remain subject to trading strategies and derivatives. But in the physical world, stress is real and growing. This convergence of rising industrial demand, constrained supply, financial layering, and geopolitical uncertainty sets the stage for significant market shifts. The usual explanations, short-term speculation, investor hype, or temporary production glitches, do not fully account for the pressure. The system is being tested at multiple points simultaneously, creating conditions where price movements may appear sudden or inexplicable to those who only observe surface-level trends. At the same time, silver's historical role as a financial hedge resurfaces. Investors who recognize the structural imbalance begin reallocating portfolios. Physical acquisition increases, vaults are emptied, and premiums rise. Retail investors often follow too late, reacting to media coverage rather than understanding the underlying dynamics. This delayed response amplifies volatility as physical markets and paper markets struggle to reconcile. The key takeaway is that silver's movement is not random. It is the result of a complex interaction between real-world scarcity, industrial demand, financial instruments, and geopolitical decisions. Each factor alone may seem manageable. Together, they create conditions for rapid and significant change. What this means for those watching closely is that strategic insight matters more than ever. Awareness of physical supply trends, industrial consumption, and institutional positioning provides an edge that cannot be captured by simple price charts. The system is under pressure, and understanding how and why it is stressed allows for better preparation and decision-making. History has shown that when scarcity and demand collide, the market's behavior accelerates faster than most anticipate. The whispers of tension become shouts, and those who remain unaware are often forced into reaction rather than action. The narrative is clear. The world is entering a phase where silver will increasingly influence industries, portfolios, and economies. It is not a question of if, but when the structural effects become visible and unavoidable. And the window to act with foresight is narrowing rapidly. As the system continues to tighten, the signs are becoming undeniable. Premiums on physical silver are surging, delivery times are extending, and large industrial buyers are competing for limited inventories. Paper markets no longer reflect reality. Futures contracts are a shadow of the physical shortages occurring globally. The disconnection between paper and physical markets is a warning that the pressure is reaching a critical point. This imbalance is not isolated to any one region. China's inventory reductions have ripple effects across Europe and North America. Major financial institutions are quietly securing physical silver, often at significantly higher prices, while smaller buyers scramble to find supply. The demand from industrial users, particularly in renewable energy, electronics, and medical devices, is non-negotiable and relentless. Once silver is integrated into these applications, it is effectively removed from circulation, making recovery in the near term impossible. At the same time, investor sentiment is shifting. Long-term holders recognize the structural scarcity and are unwilling to release physical metal at current prices. Retail investors, influenced by the rising media coverage, are beginning to follow suit, intensifying demand and pushing premiums even higher. This creates a feedback loop. Scarcity drives price increases drive more buying, and the physical supply becomes ever more constrained. Historical patterns echo this situation. Past commodity shortages show a similar trajectory: slow accumulation of tension, temporary market calm, and then rapid, seemingly sudden price spikes when the system can no longer absorb pressure. Unlike many other commodities, silver's dual role as both industrial material and financial hedge amplifies the consequences. Disruption in silver supply does not just affect investors. It has direct consequences on technology production, energy infrastructure, and even medical supply chains. Geopolitical developments further complicate matters. Countries with significant silver reserves are strategically reallocating resources, sometimes limiting exports to secure domestic supply. This adds uncertainty to already stressed global supply chains. As each nation, corporation, and investor responds to the pressure, market dynamics become increasingly volatile. Even small news can trigger outsized movements because the system is operating with minimal buffer. For those paying attention, 3 clear takeaways emerge. First, physical silver scarcity is real and structural, not just speculative. Investors and industries cannot rely solely on paper markets to gauge availability. Real supply constraints will dominate price trends. Second, industrial demand, particularly from clean energy and technology sectors, is accelerating faster than mining production. Every new solar installation, electric vehicle, or electronic device reduces the pool of available silver. Supply will remain tight unless significant new discoveries or recycling innovations emerge. Third, early strategic positioning is critical. Awareness of physical supply trends, institutional behavior, and global policy shifts allows informed decisions. Delayed action often results in paying higher premiums or missing opportunities entirely. As this scenario unfolds, the broader implication is clear. Silver is moving beyond simple investment speculation. It is influencing industries, financial markets, and geopolitical strategy in ways few had anticipated. The pressures building now will soon manifest in dramatic ways that impact everyone, from manufacturers to investors. This is not a distant warning. It is happening now. The market is being reshaped in real time, and those who understand the dynamics have a significant advantage. Awareness, preparation, and timely decision-making are the only ways to navigate this evolving landscape. The hunt for physical silver, the competition for access, and the rising premiums are all signals of a system under pressure. For investors, businesses, and policymakers, ignoring these signals is not an option. The consequences of delayed recognition could be costly. The broader lesson is a timeless one. Markets operate on the interplay of supply and demand, but when scarcity intersects with essential industrial use and financial hedging, the effects accelerate rapidly. Understanding the mechanics behind these movements, rather than reacting to surface-level price swings, is the key to staying ahead. The hunt has already begun, and the longer the shortages continue, the more intense this global race will become. Those who recognize the structural imbalances, act strategically, and prepare for continued scarcity will be the ones best positioned to navigate the unfolding silver revolution. The story is still being written, but the message is unmistakable. Silver is no longer just a commodity. It is a catalyst reshaping global markets, technological progress, and financial strategies. The time to understand, act, and adapt is now.